Welcome to the College Funding Secrets Student Loan Video Series. Video number 1, we're going to go over Stafford loans, which are also called direct loans for undergraduate student borrowers. So our Stafford loans or direct loans are available in the federal loan system, and they are capped at a certain amount of money for each year that a student is in undergraduate work. So for freshman year, they're capped at $5,500. That's the maximum amount of money they can get during freshman year. $6,500 for sophomore year, $7,500 for junior year, and $7,500 for senior year. For a total, a maximum amount of money that an undergraduate student can borrow in their own name at $27,000. And that's for a 4-year undergraduate degree. So let's look a little bit about the requirements. In order to be eligible for these federal Stafford loans, a student is required to fill out the FAFSA on studentaid.gov. And once they do, they become eligible for these loans, which are a combination of what they call subsidized and unsubsidized loans. So that $5,500 that your student is eligible in freshman year would be a combination of unsubsidized and subsidized loans according to your income level on the FAFSA. So if a student's family has a very high income level, the chances are that most of the $5,500 will be in what's called an unsubsidized loan, which means the federal government will not pay for the interest that accrues on that loan while the student is in undergraduate school. If the income level on the FAFSA is very low, a good portion of that $5,500 or all of it could come in the form of a subsidized loan, which means during the time that the student is enrolled in undergraduate school, the interest on those loans that accrues during that time frame would be completely subsidized by the federal government. And you can have a combination of both of these types of loans depending on your income level and how your family fills out the FAFSA form. But keep in mind that irregardless of whether you have subsidized or unsubsidized loans, students are not required to make payments on the actual loans while they are in school. There's nothing that stops someone from making payments on them, but you are not required to make payments until 6 months after graduation. Now, another interesting thing about the Stafford loans is that they are usually included in the financial award package from colleges, and they are not typically financial aid. They really are loans. So it's sometimes very deceiving when parents see this as part of the financial award package. They are not merit money. They are not grant money that doesn't have to be paid back. These are loans that are taken out in the student's name, and the student will be responsible for repaying those loans after they graduate from undergraduate school. But the colleges, as I said, do include them in the financial award packages. And typically most colleges do allow you to check a box that says you don't want to participate in them. So you do have that option. Now, these are, as I said before, the only federal loans that are available for undergraduate students. Now, there are some situations where undergraduate students are deemed independent from their family and from their family's income. And in that case, there are larger amounts of money that are available besides just the $5,500, $6,500, $7,500, and $7,500. But those are very unique situations. And for the vast majority of undergraduate students, these are the only federal loans available for them, which creates an interesting situation because, as we know, the average cost of college in the United States is very high. It's more in the neighborhood of $35,000 per year, which puts a big gap between the amount of money that the student can actually take out and borrow and the amount of money that it actually costs to go to school each year. And remember, the student is allowed to take out a maximum of $27,000 for all 4 years. And it's the cost of just 1 year at an average college in the United States is $35,000. So they're not even able to cover the cost of 1 year with the amount of money they can take out in their own names, which means that parents are going to need to help a student when it comes to the financial resources they need to pay for college, because they are not going to be able to borrow that money on their own. Some families will determine that they are going to use private loans, and they're going to have their students they're going to co-sign on their student's loan so that the student's name is on the loan, as well as the parents. Some parents and families will decide to cash flow some of college or all of college to make up for that gap. And then there is another option in the federal loan system, and the parents can take out money for their undergraduate student in the federal loan system using loans called Parent Plus loans. And we are going to discuss those loans in the next video.